So what exactly is a mortgage-backed security? You say you were to buy a house, you would go to a bank and they would, or a mortgage lender, and they would give you money to buy this house and you would pay them back. It's a loan, right?
Right.
Um, then the mortgage lender now basically is getting interest from you, and that's how they're getting paid. So they have two choices here. Do they hold it on their books, meaning that they get all the interest and principal back from you, or do they sell it to another company? Um, with when they sell it to another company, what they're doing is they're collecting a fee. They're upcharging a little fee on that, and then plus they're getting all the cash back that they lent out originally, which means they are now able to lend more loans out to other people applying for a mortgage. And this is how you keep the housing industry going and growing, because they can keep providing more and more mortgages. Now, what firm two does, or the second firm that buys these mortgages, they're not just buying your mortgage, they're buying hundreds and thousands and tens of thousands of all of these different mortgages across the country. And what they'll look for is they are going to package all of these mortgages together. So now, instead of your one mortgage, they'll have 1,000 mortgages in this example put together, and they're all very similar in the sense of that they're about the same duration and they have the same interest rate. And what they'll do is when they package them, that's what a mortgage-backed security is. So basically, a mortgage-backed security is just a bunch of individual mortgages bundled into one security. And then what they'll do is they'll then sell it to all sorts of investors. You can think of this as other banks, pension funds, mutual funds, individuals. And these individual investors get paid based on the principal and interest.
It's also, it kind of reminds me of almost like margin lending a little bit, um, where like you give like a collateralized asset and then you're basically taking cash and then you can take that cash and buy more stuff and then yeah, and so yeah, that's kind of interesting. But like in this system, like how does everyone really make money?
Yeah, so Bank A makes money. The one that's giving you the loan is, we're going to assume that they're going to sell these mortgages each time that after they make the loan. They make their money by upcharging a fee to that second firm. The second firm does exactly the same thing, where once they put all these mortgages together, they charge a fee for all of those mortgages to investors. And then the investors make the money again from the interest and mortgage and principal payments. Now, there's two types of mortgage-backed securities. Well, two main ones, I should say. Some are just pass-through securities, and they represent just a direct claim on a pool of mortgages. So these specific mortgages, you have a direct claim to. The other are called collateralized mortgage obligations. This is a little more complicated. I'm not going to get into full detail, but basically, and this is a term you would have heard a lot during the financial crisis, is they take pieces from all these different mortgage-backed securities and then put them in a customized instrument. So some are riskier than others because some mortgages are more risky than the rest. So what they'll do is they'll basically piece these all together, and you can decide what type of risk you want to take, what type of return you're looking for. But again, those are more complicated. And this was one of the major issues with the financial crisis. Maybe we'll get to in a bit.